let's go. Alright, looking forward to this, guys. FOMC. Hmm. Read, read, and the low is taken. I found higher time frame. Alright, guys, what you thinking? Bullish or bearish for FOMC? I know a lot of people are saying bearish and bullish. I don't know. Let's see what happens though. Alright, guys, I'm so excited for this shit. Let's see. Alright, let's lock in real quick. Tap there. It's a nice 4 hour low right there, actually. We got two lows to look at. Nice 1 hour OB right there. Can't overcomplicate it, just gonna enter. Yo, I see a setup right now, but I'm scared to take it because it's still before news. Shit, yo, it's big stuff. Hold on, let's get. See if we can watch the live stream. Sure.
Outlook for, say, inflation and or growth or the unemployment rate, how many months does it take, and what do you want to see in the data to get to that level of confidence to actually reduce rates off the restrictive level?
So it's very, very hard to say when that will happen. We know that the time will come. It could come quickly. It could not come quickly. As long as the economy is solid, though, as long as we're seeing the kind of labor market that we have and reasonably decent growth and inflation moving down, we feel like the right thing to do is to be where we are, where our policy stance is, and just learn more. And in particular, we feel like we're going to learn a great deal more over the summer on tariffs. We hadn't expected them to show up much by now, and they haven't. And we will see to the extent to which they do over coming months. And I think that's going to inform our thinking, for one thing. In addition, we'll see how the labor market progresses. So at some point it will become clear. I can't tell you exactly when that will be. And meanwhile, we'll be watching the labor market very carefully for signs of weakness and strength, and tariffs for signs of what's going to happen there. And of course, there are many developments ahead. Even in the near term, developments are expected on tariffs. So I think we don't yet know with any confidence where they will settle out. We have an estimate, and I think all estimates are now pretty close together, but it's highly uncertain.
When you say estimate of the impact of tariffs on the core PCE, is that what it is? And could you share that?
Yeah, what you start with is what's the effective tariff rate overall, and people are managing to that. But the pass-through of tariffs to consumer price inflation is a whole process that's very uncertain. As you know, there are many parties in that chain. There's the manufacturer, the exporter, the importer, the retailer, and the consumer. And each one of those is going to be trying not to be the one to pay for the tariff. But together, they will all pay for it together, or maybe one party will pay it all. But that process is very hard to predict. And we haven't been through a situation like this. And I think we have to be humble about our ability to forecast it. So that's why we need to see some actual data to make better decisions. We'd like to get some more data. And again, in the meantime, we can do that because the economy remains in solid condition.
Nick Tamarosa of the Wall Street Journal. Chair Powell, I guess I'm wondering if you could explain a little bit more the divergence we see in the dot plot, particularly around the 2025 rate projections. I realize this is, you have one group of officials that are putting down no cuts, another that are putting down more than one. And again, recognizing that could be difficult to summarize, but is it a matter of people having a different outlook or a different reaction function, a different commitment to defending against another inflation mistake? How did that play out over the last 2 days?
So you're right. This is often the case. We have a pretty healthy diversity of views on the committee. We did have strong support for
Alright, bro. Let's see. Let's see. 30 seconds, man. 30 seconds. Nah, that's some crazy shit, bro. What am I seeing on gold? ES swapped all this again. see this is data highs we're about to take out. I just took out data highs. Beautiful. Beautiful trade. Come on now. Let's not forget, guys. Jerome Powell hasn't even spoken yet. Jerome Powell, bro. What the frick are you gonna do? Let's see. Let's see. He hasn't even said anything yet, bro. I think that's at 12:30 still. Beautiful trade. Beautiful, 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 beautiful. This is a data highs right here that we took out. Woo, man, we are just straight dumping. Goddamn. How many points is there? 150 points already, guys. Shit, I know nobody's watching, but like, hey, I just caught 150 points, bro. Come on. That's crazy. I was wanting to see if I could like scale in a little bit more, but shit, as long as you just want to go straight to my TP, I ain't gonna complain. Alright, so there's the first objective, but let's see. Let's see. Oh, we just got so much like liquidity all the way down, dude. Like, god damn. But I'm gonna be greedy. I might take one con off right now. How much am I even up? I'm up a band. Damn, bro. Definitely could have been up more, but I just want to see if I can catch a continuation. But yeah, these two targets are super clean, super clean. I know I recorded everything in the live, did my quick analysis. Shit, boy. Alright, so we just get that inverse. That's not a run. That was a super clean sweep and inverse as well. High key should be scared that we might just reverse. We gotta have trust, you gotta have faith. Faith in no setup. If anything, I'm just looking to scale in more still, because my overall draw is all the way down here, man. Oh, that is a daily SVG, huh? Damn, I didn't even peep that. That definitely should have been my TP. That's okay though. That would have been a bad. Let's see if Green got to it today. Guys, Jerome is still gonna speak. Open up a 5 minute gap. Yo, TJR just made 400 bands, bro. And I'm out here trading with 3 micros. Come on. That's crazy, man. That's crazy, bro. Shorts are just super, super clean today for sure. Jerome Powell, where you wanna speak? Man, Jerome Powell, bro. So, dude, I don't like that chat. I don't like that. Yo, it might be cooked here. Like two. Just a 5 minute change. Yo, Jerome Powell's about to speak in like 5 minutes. Yo, guys, I'm on this one. These vlogs are stupid. I might have been too married to my bio. But let's see. I'll just take this one, guys. Let's see. Here's another setup. Alright, guys, Powell's here. Powell's here.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. While the unemployment rate remains low, it has edged up, job gains have slowed and downside risks to employment have risen. At the same time, inflation has risen recently and remains somewhat elevated. In support of our goals and in light of the shift in the balance of risks, today the Federal Open Market Committee decided to lower our policy interest rate by a 1/4 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a pace of around 1.5% in the first half of the year, down from 2.5% last year. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles has picked up from last year's pace. Activity in the housing sector remains weak. In our summary of economic projections, the median participant projects GDP to rise 1.6% this year and 1.8% next year, a touch stronger than projected in June. In the labor market, the unemployment rate edged up to 4.3% in August, but remains little changed over the past year at a relatively low level. Payroll job gains have slowed significantly to a pace of just 29,000 per month over the past 3 months. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and lower labor force participation. Even so, labor demand has softened, and the recent pace of job creation appears to be running below the break-even rate needed to hold the unemployment rate constant. In addition, wage growth has continued to moderate while still outpacing inflation. Overall, the marked slowing in both the supply of and demand for workers is unusual. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. In our SEP, the median projection for the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.7% over the 12 months ending in August, and that, excluding the volatile food and energy categories, core PCE prices rose 2.9%. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up, on balance, over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 3.0% this year and falls to 2.6% in 2026 and to 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a 1/4 percentage point to 4 to 4.25%, and to continue reducing the size of our balance sheet. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to push up prices in some categories of goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. With downside risks to employment having increased, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.6% at the end of this year, 3.4% at the end of 2026, and 3.1% at the end of 2027. This path is 1/4 percentage point lower than projected in June. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Policy is not on a preset course. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
Great. Thank you. Chris Rugaber at Associated Press. As you know, Fed Governor Stephen Miron has kept his position at the White House, even as he's joined the Fed board. This is the first time, I believe, the Fed's board has had someone with executive branch ties in decades. Does this compromise the Fed's independence from day-to-day politics? And relatedly, how can you maintain the public's perception the Fed is politically independent with this dynamic? Thanks.
So we did welcome a new committee member today, as we always do, and the committee remains united in pursuing our dual mandate goals. We're strongly committed to maintaining our independence, and beyond that, I really don't have anything to share.
Well, great. And then just as a quick follow-up, I'm sorry, can you and other Fed officials have spoken extensively about the impact of tariffs on inflation, although perhaps with many companies appearing to eat the tariffs, tariffs may be impacting the labor market and other parts of the economy instead. Do you see that as a possible outcome here, that tariffs are the reason we're seeing some slowing, particularly in the labor market, rather than in inflation? Thanks.
You know, it's certainly possible. You know, we're beginning to see, we have begun to see goods prices showing through into higher inflation, and actually the increase in goods prices accounts for most of the increase in inflation, or perhaps all of the increase in inflation over the course of this year. Those are not very large effects at this point, and we do expect them to continue to build over the course of the rest of the year and into next year. And you know, it's also possible that there may be effects on employment, but that I would say if you're looking at why employment is doing what it's doing, that's much more about the change in immigration. So the supply of workers has obviously come way down. There's very little growth, if any, in the supply of workers. And at the same time, demand for workers has also come down quite sharply, and to the point where we see what I've called a curious balance. It's, you know, typically when we say things are in balance, that sounds good, but in this case, the balance is because both supply and demand have come down quite sharply. Now demand coming down a little more sharply because we now see the unemployment rate edging up.
Whatever happens, man, I'm locking myself out.
Wall Street Journal. Chair Powell, do economic conditions and the balance of risks no longer warrant a restrictive policy setting?
So I don't think we can say that. What we can say is this, that over the course of this year, we've kept our policy at a restrictive level, and people have different views, but a clearly restrictive level, I would say. So, and we were able to do that over the course of this year because the labor market was in very solid condition with strong job creation and all those things. I think if you go back to April and now look at the revised job creation numbers for May, June, July, and August, I can no longer say that. So what that means is that the risk, which the risks were clearly
gonna
tilted toward inflation.
it's
I would
another
say they're
trade, guys.
moving toward
Stupid, I
equality.
took
Maybe
too
they're
many
not quite
trades
out of
today.
equality. We don't need to know that. But we do know that they've moved
Watch it go
meaningfully
straight to
toward
TP now.
greater equality, the risks between the two goals, and that suggests that we should be moving in the direction of neutral, and that's what we did today.
This first
Under
trade
what
was crazy, though.
circumstances would a larger
trade
than
was good.
25 basis points rate cut be warranted? And how seriously was that option
At least I
entertained
got
at your meeting
days
this
for
week?
the account.
There
I
wasn't
just activated
widespread
this
support
last
at all
night.
for a 50 basis point cut today. You know, I think we've done we've done very large rate hikes and very large rate cuts in the last 5 years, and you tend to do those at a time when you feel that policy is out of place and needs to move quickly to a new place. That's not at all what I feel certainly now. I feel like our policy has been doing the right thing so far this year. I think we were right to wait and see how tariffs and inflation and the labor market evolved. I think we're now reacting to, to the much lower level of job creation and other evidence of softening in the labor market, and saying, well, those risks are maybe not fully balanced, but moving in the direction of balance now, and so that warrants a change in policy.
Colby Smith for the New York Times. Should we be viewing today's cut as the committee taking out some insurance against the possibility that the labor market is at risk of weakening, or is it the committee's view that the dynamics of a downturn are already in place? I guess I'm just, trying to square the shift in the rate forecast in the SEP towards more cuts than just 3 months ago, with the fact that the forecast for unemployment
I'm
didn't
done
change.
trading. I locked myself out.
Yeah, I think you could think of this in a way as a risk management cut,
Definitely
because
no, I could
if
have
you
done
look at the
this
SEP,
better,
actually,
but it's whatever. At least I'm
the projections for
disciplined
growth
enough to
this
just
year
stop
next actually
there.
ticked up just